Good morning, everyone. As the Market Risk Advisory Committee's designated federal officer, it is my pleasure to call this meeting of the MRAC Future of Finance Subcommittee to order. Before we begin this morning's discussion, I would like to turn to Commissioner Kristen Johnson, the sponsor of the Market Risk Advisory Committee, for opening remarks. Commissioner Johnson.
Thanks so much, Tamika. Good morning, everyone. It's my pleasure to welcome you to the Market Risk Advisory Committee's Future of Finance Subcommittee meeting. Increasingly, diverse industries and sectors of our economy identify opportunities to integrate aspects of the assemblage of technologies that we commonly describe as artificial intelligence, or AI. AI enables doctors to diagnose and map diseases faster, earlier, and with greater accuracy than ever before in the history of medicine. Farmers who cultivate crops that feed our nation may integrate AI to better manage access to vital resources such as fresh water, enabling more efficient irrigation, fertilization, and crop rotation, leading to more sustainable farming. In our markets, AI offers similar efficiencies for faster trade execution and settlement, more accurate pricing prediction, and more precise risk management oversight. Markets have witnessed increased adoption of AI, including AI-driven investment advising, trade execution, risk management, and market surveillance. Notwithstanding this promise, we must account for the potential perils of integrating innovation without proper guardrails. A few years ago, a branch manager of a Chinese company in Hong Kong received a call from the director of its parent business. The instructions delivered during the call indicated that in connection with a pending acquisition, the bank employee should transfer $35 million to a designated account. Having received emails confirming the legitimacy of the transaction, and because he had spoken often with the director by phone and recognized his voice, the branch manager kindly obliged, followed the instructions, and transferred the funds. The calls and emails were deep fakes that relied upon, among other technologies, AI voice cloning technology, and the transfer was an Ocean's 11 style scam. As this final use case illustrates, the ability of machines, or more specifically supervised and unsupervised machine learning algorithms, to process vast quantities of data to address disease, water management, or food scarcity is only part of the story. Regulators have identified notable concerns regarding the development, testing, and deployment of AI. Multiple standard-setting authorities note the need for increased oversight regarding a governance, development, testing, monitoring, data quality, and bias, transparency and explainability, outsourcing, and ethical concerns. As a primary concern, it is imperative to increase market and prudential regulators' understanding of how the underlying technology operates and the integrity of the inputs it relies upon, as well as the potential for neutral technologies to engender biased outcomes. In October of 2022, many of you are familiar with the White House having launched, through the Science and Technology Policy Office, a blueprint for an AI Bill of Rights to support the development of policies and practices that protect civil rights and promote democratic values in the development of AI. Many of you are also aware that at the end of last year, the Biden administration announced the creation of an AI Safety Institute housed within the Commerce Department, which will establish within NIST, the National Institute of Standards and Technology, a framework or operationalize a mechanism for AI risk management, or for an AI risk management framework. To support the AI Institute, NIST announced this month the creation of the AI Safety Institute Consortium, a member of which is IIF, and Jessica Rainier, one of our MRAC members, an MD at IIF, will provide some reflections later today on these questions. We're not alone in starting to face the challenges that integrating AI presents for our society. International standard-setting bodies are continuing to contribute to the work that would be important for developing guidelines for identifying and evaluating AI capabilities, with a focus on the capabilities that could potentially harm financial markets or other aspects of our society. Very specifically, the FSB in 2017 issued a report on market developments related to AI and financial stability. In that report, and alongside that report, we see reports or consultations from reports and consultations from the International Organization of Securities Commissioners, the Financial Stability Oversight Council, and the Financial Industry Regulatory Authority. When we look across or survey the recommendations that have been proposed, there are a few commonalities. I believe that these commonalities should offer a principles-based approach for informing our regulatory oversight of markets in the context of the adoption of AI. Let me offer just a few reflections on these commonalities. First, there needs to be a focus on the governance of AI models. FSOC recommends monitoring the rapid developments in AI, including generative AI, to ensure that oversight structures keep up with or stay ahead of, where possible, emerging risks to the financial system. Similarly, IOSCO has recommended that regulators should consider requiring firms to have designated a senior management official responsible for the oversight, development, testing, deployment, monitoring, and controls related to AI. I think a second principle would require promoting the explainability of AI models. This is a principles-based approach that has been articulated in each of the consultations or reports that I mentioned a moment ago. It's imperative as we move forward to be thoughtful about the need for data controls. And in addition to need for data controls, the implementation of measures to address bias. Finally, testing and monitoring of output is a critical element of our oversight of AI technologies. 5 years ago, I began to convene and participate in convenings of AI developers, adopters, academics, government and industry researchers, and regulators, as well as public interest organizations. In 2020, a co-author and I received invitations to publish 2 books, one of which examines the ethical implications of AI across diverse sectors of our economy. In 2 recent speeches, a speech last month before the New York City Bar and a speech last week in Tokyo at Japanese FinTech Week, I advocated for the CFTC to begin to identify best practices for integrating AI in our markets. Among the very specific suggestions I made, I suggested that we have greater visibility and transparency regarding our registrants' use of AI, meaning beyond the recently issued RFI, I would suggest that the Commission expand our annual systems examination questionnaire to incorporate questions that directly inquire about the adoption of AI. I also advocated for a principles-based framework that thinks carefully about intelligibility, risk management, compliance, oversight, market responsibility, notice, and explainability. I suggested that in the context of the use of AI to perpetuate fraud or market manipulation, we should include heightened penalties in our regulations. And then finally, I encouraged the adoption or the development of an interagency task force focused on information sharing across financial market and prudential regulators. I'm excited to hear from today's subcommittee because all of my thoughts and ideas have already been informed by the work and conversations that so many of you are engaged in. I'm looking forward to hearing from each of the panels and panelists that will present later today. I'll leave to DFO Tamika Bent and ADFO for MRAC, Peter Janowski, a description of exactly which panelists are participating in which panels. It's going to be an exciting, fulsome, and thoughtful day. I do want to express my gratitude and appreciation in advance for our chair, Alicia Crichton, support, as well as my staff, Julia Welsh, ADFO for the Future of Finance Subcommittee, Tamika Bent and Peter Janowski here alongside me leading the meeting, and Rebecca Lewis, ADFO for 2 other MRAC subcommittee meetings. I'm also grateful to each moderator, panelist, and committee member for your presence today and your continued work in these areas. I look forward to today's important discussions.
Thank you very much, Commissioner Johnson. Before starting our discussion, there are just a few logistical items that I have been asked to mention to the subcommittee members and invited guests. Please make sure your microphone is on when you speak. This meeting is being simultaneously webcast, and it is important that your microphone is on so that the webcast audience can hear you. If you would like to be recognized during the discussion, please change the position of your place card so that it sits vertically on the table, or raise your hand and I will recognize and give you the floor. If you are participating virtually and would like to be recognized during the discussion for a question or comment or need technical assistance, please send a message via the Zoom chat, which my colleague Rebecca Lewis will be monitoring. She will alert me that you would like to speak. a few other items. Please identify yourself before you begin speaking and signal when you are finished. Please speak directly into the microphone or for optimal quality on the webcast. Please unmute your Zoom video before you speak and mute yourself after you have spoken. Only turn your camera on when you are engaging in conversation. If you are disconnected from Zoom, please close your browser and re-enter Zoom using the link that was previously provided to you today. One last point to mention. The Climate-Related Risk Subcommittee of MRAC will meet immediately following this meeting. And there may be members of the Climate-Related Risk Subcommittee in the room today at the moment. We welcome, just one second. We welcome those invited for that subcommittee to watch this subcommittee meeting, but we ask that only the members of the Future of Finance subcommittee and speakers invited to the Future of Finance meeting participate. The inverse will be true for the Future of Finance subcommittee when the Climate-Related Risk subcommittee meeting commences. Okay, we will now begin today's agenda. The focus of that panel is what current financial market rules are implicated by AI. The panel members are Jason Harrell, Managing Director, Operational and Technology Risk and Head of External Engagement for DTCC, David Felsenthal, Counsel to Chairman Ross Benham at the CFTC, Chen Arad, co-founder and Chief External Affairs Officer at Solidus Labs. And the panel will be moderated by Petal Walker, member of the Advisory Board of Liquidity Law Global Markets. Petal, over to you.
Thank you, Tamika. So very excited to layer on some more dimensions to this conversation. We're going to really have this fast discussion in three parts. First, we'll talk about the regulatory reality currently outside the CFTC. This is the regulatory panel after all. So what's kind of happening outside the CFTC with other regulators? Then we'll move into the CFTC's interaction with AI, try to get deeper into the CFTC rules. And then we'll end off with a conversation about the risks and benefits of AI, really focused on the regulatory perspective, okay? So let's jump in with what's happening outside the CFTC in terms of regulation domestically and internationally. And I'm going to turn to David first to start off our domestic conversation, then we'll move into the international with Jason. David, can you start us off?
Thanks very much. I'm David Felsenthal from the CFTC. I think the first thing that's come out is the AI executive order, which has been mentioned. And it's obviously, for us at the CFTC, something of great interest. We've really focused on it and looked how it affects both our internal policies in terms of how we use AI, and also external policies in terms of how we supervise our registrants' use of AI. So that's something, part of what we've been looking at. The NIST report, which has been mentioned, is another thing that we've also been using, particularly in thinking about our own use of AI. And there have been many other things. I won't spend too much time going through them, but obviously it's critical for us, and we have been reviewing many of the other governmental and non-governmental reports. But let me hand it back to you at that point.
Sure. Is there anything from the NIST or the executive order that stands out in your mind as being very helpful directionally for us at the CFTC? Just, there definitely tend to be general kind of statements, but just trying to see if anything stands out significantly.
I think the two things that stand out in my mind are, one, on the internal side, a great deal of concern about what data we or any other agency use and how we get that data, and how we use it, and what biases, but what other issues there may be with the data that we're examining. I'd say the second point is on the external side. The executive order in particular focuses on customer protection. And obviously in the CFTC markets, that doesn't necessarily mean the same thing as it does in other financial markets, but it is a topic obviously of great focus for us and something we've been very thoughtful about in the context of IT.
Okay. Jason, any thoughts on that, and even expanding over to the more global side of things?
Yeah, what I will say about the NIST AI risk management framework is it provides an overarching way of managing the risks that are identified within AI. It does so in a very non-sector specific. It covers a range of use cases. Any organizations can use it. But I think the current challenge with the risk management framework and a challenge that we're seeing more globally is the ability for these frameworks to say how things should be tested. So, going beyond, how am I going to manage the risk once I identify a risk, but how do you actually get comfort that you are identifying the risk in these AI technologies and systems? So I think that's one area where there still needs there's still room to grow. And yeah, NIST acknowledges this in the development of their risk management framework, acknowledging that as the global standards start to mature, we get better use cases. You'll see more additions to the risk management framework. So it's a work in progress, but it's definitely the first of a stepping stone to get us where we need to be as a financial sector community.
Might I just interject just for 1 second? Just a brief reminder that when you are not speaking, it's really important to turn off your microphone.
And in terms of the NIST framework, do you think that, being that it's not focused on financial markets, do you think it has great utility in terms of really focusing on our markets, in terms of its its translatability to our sector?
Yeah, I believe it does, and I think that was actually done on purpose by NIST. They're trying to cover a number of the sectors, especially the critical infrastructure sectors. So it is designed. It could be used financial institutions. It could be used in power and other sectors. So I believe that as it continues to move forward, you'll see greater utility across all sectors.
Excellent. And of course, the U.S. is not the only jurisdiction that's thought about these things, right? There are other jurisdictions, EU, Brazil, et cetera, that have rules and ideas and proposed rules. Yeah. And Jason has undertaken to give us a little spattering of those global regulators.
Thank you. So first, what I'll say is that there hasn't been a proactive response on AI that is specific to the financial services sector. Regulators have emphasized the use of existing regulations to manage the risk relative to AI. More specifically, and we heard from the last panel, using model risk management requirements, using third-party risk management guidance, and then general risk management in order to manage these risks. But however, AI presents, as we've already noted, specific risks that additional guidance may be needed. But there have been activities that have been happening on a global basis that the CFTC may be able to obtain some insights from. And so in sharing those, first in the U.S., the U.S. Treasury will be issuing a report later on this month, which is also based on their requirements from the executive order on managing the AI risk within the financial markets. So that's something that's coming up where additional insights may be gathered. Also, as part of the executive order, it pointed to the 2023 interagency guidance on third-party relationships, which also has requirements and expectations relative to transparency and explainability of AI models. The SEC has also proposed a rule requiring that broker-dealers and investment advisors take steps to avoid conflicts of interest stemming from predictive analytics, and their predictive analytics rule. Further, in the UK, the UK actually issued their vision on AI regulation in their policy paper. It's called A Proactive, Innovative Approach to AI. and it basically calls for a regulator-led, sector-specific approach. Off the back of that, the UK PRA and the Financial Conduct Authority have actually done some information gathering on AI use, so there might be some partnership opportunities there to learn more about what they have seen. And then also the UK Bank of England and the Financial Conduct Authority produced a summary of the industry responses to AI and machine learning. So there is some information about what they found, and that's in their FS2/23 artificial intelligence and machine learning paper. And while they've done all of this work, there hasn't actually been any regulatory guidance from these agencies. But again, it provides insights into the use of AI within the financial markets.
I'll pause you there. And so it's very clear that we have a lot to work with if we want to pull from these other regulators. I mean, Jason hasn't even gotten to China and Brazil, and there's already a very rich store of information there. So that's been very useful. I'm going to shift gears a little bit now to our world in the CFTC. And so there was some conversation earlier about AI market participants, but I'm curious, David, in terms of the CFTC specifically, have we had a lot of engagement on this issue with market participants, from a regulatory perspective that we can learn from?
Yeah, I mean, I'd like to start by emphasizing, as David Palmer did, that we see AI as part of the ongoing technological developments in our market. We don't see it as a sort of a cliff jump. Obviously, there are significant developments, but it's part of an ongoing extension of how we work with technology and work with our registrants. So in terms of that, in terms of interaction, obviously we do have ongoing exams and supervision, and part of that is reviewing the IT and all the technological developments that have been involved. We do we do require our registrants to tell us when they're making significant changes. So in connection with that, a lot, model changes are part of it, IT changes are part of it. So we review those, and that's sort of the fundamental ongoing supervisory part of it, which is critical. In addition, from a sort of more policy perspective, as you probably know, we've issued a request for comment recently, and in connection with that, we are reaching out to our registrants and encouraging all of them to respond, to let us know how they're using it, and what appropriate measures should be in place for guidance and ongoing supervision. So there has been ongoing interaction with them both at the supervisory level and at the policy level.
What I'm not hearing is concern, fear, and alarm, which is probably a good thing. It seems as though, this has been part of the overall oversight of the commission, and so it's not as if there are major surprises coming as companies are changing their technology. Maybe I'm overstating it, but I want to just make sure I'm clear, because I didn't hear terror in there.
I do think, any development of technology has the potential for having surprises. So, I wouldn't cast aside the issue of whether something new and difficult may be coming up, but I do think it's part of an ongoing work stream, the supervision in particular. And one thing I should point out as well that we're very concerned about is fraud. I mean, Commissioner Johnson started this meeting by talking about a particular scam, and we're very aware of those and very worried about AI use in scams. And so one thing we did is issue a customer education piece about use of AI in scams. And so that's been published and it's available, and it's something, again, we're focused on thinking about how we can help to avoid the use of AI in scams.
Excellent. So ongoing engagement with the right touch of concern, it sounds like. Perfect. So now looking at the CFTC regulatory landscape, right, there are certain areas that we are familiar with, clearing, execution, reporting. We have lots of registration requirements. Just taking a stab at that, David, in terms of where you think AI's implications may lie within that regulatory landscape. Is it a reporting issue, probably, or a record-keeping issue? I know it's kind of just very broad, but it's kind of getting a sense of areas in which you think there may be implications for regulation.
Yes, I mean, obviously, this is something we think about a lot in terms of, in CFTC speak, what core principles apply and are picked up, in the looking at AI. And I would point to, I mean, as you mentioned, record keeping and reporting, obviously, that's one area where we sort of have to understand the role of AI. Other things I'd mention particularly is monitoring of trading and trade processing. I mean, as many of the panelists have commented, that is obviously a potential use of AI, and what that means, how you use AI to analyze data in that context is something we want to understand and work on. System safeguards, so again, a point that's been made about cybersecurity and how AI's role there, risk management, obviously, and again, not just reporting, which you mentioned, but record keeping as well, how records go back and forth. So those are all issues, where we've sort of core principles where we've been looking particularly at the impact of AI. And then I guess the last thing I'd touch on, which again, the panelists has discussed, is outsourcing and how that fits into our control of outsourcing models. Very, very important in the AI space. But I mean, again, I just want to emphasize what I said earlier, and I think David Palmer said as well, is these are core principles that have been in place for a while, and it's a question of how AI fits.
Okay, excellent, thank you. So we'll shift now to our last segment, which is really the discussion of benefits and risks, specifically from a regulatory perspective. And I actually want to turn to Chen, who is on the Zoom. He's on there.
Yes.
Chen, are you?
Yes,
Perfect, great. Could you start our conversation off on some of the benefits you see from AI, specifically from the regulatory perspective?
Absolutely. Thank you, Pat Owens. Thank you, Commissioner Johnson, for the opportunity to speak here. We are very focused on specifically preventing market manipulation and abuse in the digital assets and crypto space. I think it is important to acknowledge that the AI transformation is also happening where there are other budding transformations in the financial industry. The use of blockchain, the experimentation with permissionless systems, etc., which in some ways go hand in hand. In terms of new risks, and it has been touched by some of the former panelists, naturally, some of the first adopters of new technologies are illicit actors. And specifically when it comes to fraud and market manipulation, there's definitely, unfortunately, a lot of application of AI that we see. For example, the use of bots, which is not new, is definitely something that has become, in our experience, more scalable and in some cases harder to detect when augmented with the use of AI. For example, risk monitoring has historically been based on a rule-based principles, and by utilizing generative AI, you can sometimes, for example, deploy a bot that executes wash trading in ways that are harder to detect, that keep on changing and adapting, etc. One of our research papers, for example, was looking at smart contract scams, and there's a huge proliferation of that in decentralized markets. As many as every 4 minutes, we believe there's a new smart contract scam detected, and part of the way we explain that is because it's very easy to generate code and then regenerate and change it to perpetrate new scams. So essentially, there are more sophisticated ways to avoid detection, and generative AI specifically is very, unfortunately, useful for illicit actors to generate more scams in a more sophisticated way more often. However, there's also a huge benefit from a risk monitoring perspective, and it really and compliance with regulation, and it really boils down to two parts. One of them is in the detection side, and the other is in the operational side. We have been utilizing machine learning models, specifically more often supervised than not, in augmenting rule-based systems, rule-based detection models, specifically for market manipulation for about 6 years now. And we have seen that when used correctly and with the right supervision, both in terms of creating guardrails for the way they are detected and in terms of constantly adapting and checking the results. There's been significant reductions in false positives reported by compliance teams, using those to detect things all the way from market abuse, to transactional concerns. At the same time, on the operational side, which is sometimes overlooked, oftentimes, there's a big focus on detection and how you can use statistical models in detection of abusive behavior. On the operational side, essentially, there's a really big opportunity to augment the work of compliance professionals and risk professionals. So in that sense, making sure using AI, for example, to more easily and efficiently decide what should be escalated or not escalated, allows risk professionals to focus on the real sources of risk.
Okay, I'll have to pause you there. This is all very helpful. We have a few minutes left. I definitely want to get to the cybersecurity risks that you spend a lot of time on, Jason, in your day job, and other risks that you want to kind of catch on before we close out. Thank you so much, Chen.
Sorry, here we go. I guess, as I've been listening to the different panelists, I would say a couple of things. One is, we're not going to eliminate all of the risks associated with AI. What we need to do is to understand the risks that we can manage, understand the risks that we have residual, and then figure out a way forward once we make those determinations. So I will say that. As it pertains to AI and some of its risk, and I'll just talk on this briefly. As was mentioned earlier, AI requires large data sets, but these data sets can change over time and unexpectedly, which can also then lead to the systems functioning in ways that are very hard to explain. And we talked about the inscrutable AI systems that we see. And then further, AI systems also require context. So being able to understand the context in which that AI system should be used is also very important. However, most of the time when humans use AI systems, they think they are there for all contexts. And that is the other challenge that I believe we're going to see as we use AI systems, is not understanding those challenges, which leads me to the third party point, which is as many firms can't afford to develop AI systems internally, they'll be forced to use AI systems that are developed by third parties, which then means that they don't necessarily have the full context of how that AI system is supposed to be used. Further, they will struggle with explainability because the explainability of that model may not be fully understood and may be proprietary to the third-party provider providing the AI system. And so we need to understand that.
Sorry, I have to pause you there. I'm so sorry, just because of time.
Yeah.
This has been a very rich discussion. I think there's much more to learn here. Thank you to my panelists, and I'll move on to the next.
Thank you. Thanks, David. Sorry, that was the prior panel, but yes, there is David Felsenthal. That was correct. Jason, I know, Chen and Petal. I know that we have a very ambitious agenda, and we want to keep to the timing that we've set out in the agenda. So we are going to move immediately to the next panel. And that panel is on AI-related risks, and I know we've covered some of that already. Our panel members are Yesha Yadav, Professor of Law, Milton Underwood Chair and Associate Dean at Vanderbilt Law School. Pauline Kim, Professor of Law at Washington University in St. Louis. Eamon Hart, PhD in Math from Drexel University at Chaminade, and myself. The moderator for this panel is Rebecca Rettig, Chief Legal and Policy Officer at Polygon Labs. I think for this one we do have slides, but Rebecca, over to you.
Thanks so much, Tamika, and thanks for accommodating me virtually today. I appreciate the topic of this discussion. because we've seen AI moving so fast in our world, as we have with a lot of different types of innovation. And the intersection of innovation and the financial world is obviously of great importance, and specifically to the Market Risk Advisory Committee. I thought the final comments of the last panel really did a great job bringing us into today and thinking about the risks. And I wanted to start with Professor Yadav and thinking about where AI is and what it will do, and then how we can really try to think about mitigating liability for those as we move forward.
Thank you so much, Rebecca, and thank you so very much to Commissioner Johnson. Thank you so very much to the terrific staff for putting together this really important, extremely timely decision on the future of AI, and particularly the regulatory response going forward. I think we can learn a lot about the next steps for overseeing AI by looking at what has happened over the last decade. As much as we are thinking about AI as the future, there's been a lot that's happened in AI over the last decade that I think has taught us a great deal about how regulation might be able to respond to the challenges going forward. In particular, I wanted to sort of feature and highlight the role of trading systems, and in particular, the role of high-frequency trading systems that have already demonstrated incredibly sophisticated, highly independently operating AI over the last, certainly decade and a half. And I thought I might take us all back to a day that does live in infamy, May 6, 2010. That was the day of the flash crash when the Dow dropped almost 1,000 points before rebounding, but not without unleashing a whole sense of catastrophe about what exactly had happened. And in looking around to see what had gone wrong, the blame had fallen upon a spoof trader and a spoof algorithmic trader, Navinda Sarao, and in particular responses of other trading algorithms to his bad activities. So many of the other trading algorithms became disorientated in the wake of Navinda Sarao's spoof algorithmic trading, unleashing, as we know, just incredible amounts of catastrophe over an very highly interconnected marketplace. Now, what this extreme example does highlight are some of the issues that we've been discussing throughout the day, which is that, in the case of these highly intelligent, proficient algorithms, sometimes it's very hard to know how these things are going to behave before the fact. The issue of explainability has come up multiple times today, right? It's hard sometimes to understand how the code will respond in real time to ongoing feedback, and more importantly, in some cases, the response of other algorithms to a single algorithm that is operating in the marketplace. So that's one thing. In addition, there's the fact that in a highly interconnected, very fast-moving market, right, we can have enormous amounts of losses that can happen in a very quick amount of time, right? And this can be resulting in liability and cost that is far too high for one single trading firm to bear all by itself. So, these are some of the challenges that we're facing today. Now, obviously, with high-frequency trading systems, I think it's worth remembering that these are the dominant volume generators in many of our trading marketplaces today. They are constantly hoovering up data. They are taking data from large amounts of natural language processing, from Twitter, you name it, and generating an output independently in real time, right? Through the price mechanism to submit orders to an exchange or a trading venue. Now, in the case of thinking through what the use of these systems has taught us, I think many of us in this room have been working on regulation of HFT and other algorithmic trading for the last decade and a half, and there's some learning that obviously we have developed here. And in particular, a couple of issues stand out, which is how to create good accountability mechanisms for these very hard to explain, but fast moving and, potentially high cost damage algorithms that might exist. First and foremost,
I hate to stop you, but I do want to make sure that we stay on today. So if you can sort of, I know it's hard to summarize, but summarize in a few minutes.
I will summarize in just one teeny second. Thanks, Rebecca. First of all, right, just looking at the reasonable standards, which is to say, what is reasonable in this context, right? How do we think about reasonable risk taking? when we're looking at a reasonable standard that guides rulemaking and regulation throughout our CFTC regulatory system, unreasonable risks are the ones that are punished, but how do we think about reasonable risk taking when the damages can be so large? And secondly, and I'll be really quick about this, Rebecca, of intent. When we do have highly generative algorithmic trading systems, how do we think about intent? Specifically, notions of fraud, malicious trading, spoofing. In that context, as we heard before, sometimes algorithms are playing with other algorithms. In that context, it can be rational to engage in fraud. It can be rational to engage in disruption. And so in that context, how do we think about attributing notions of intent in this context? Do we just hold the trading firms liable? Or do we think about other mechanisms that could be applying here? These are challenges that we have been confronting. I really commend the CFTC. I really commend Commissioner Johnson for beginning this discussion. And I think, there's so much to learn and go forward with it in this space. So thank you so much. And thanks, Rebecca, for the extra few.
Thank you so much, Professor Yadav. And I think the ending there and some of the things you said really take us well into the next remarks from Ms. Kim. And the idea, and I just listened to a podcast about this on AI last week, where if you do not like what information you're being given from a particular AI generated sort of information system, that you can pick your either political stance or other sort of perspectives that you'd like your AI information to come to you from. And I do think that when you're saying there are the risks of the way the information is presented, some of them are obviously on the financial side, but some of them may come with other sources of bias in many ways. So I'm hoping our next panelist, Ms. Kim, can talk to us a little bit about those risks as well.
Thank you. And thank you so much for the opportunity to present our research today. I do have slides, but given the time, I don't know if that's easy to get them.
We do have the slides available, and I think we can go through them.
Okay, great. So I'll go ahead and start talking in the interest of time. This is joint work. It's a paper that I have worked on with Emily Black, Logan Kopke, Solon Barakos, and Ming Xu. And the focus of this paper is on a slightly different kind of risk than what you've been talking about before, which is the recognition now that we have that AI systems can be biased. They can reflect or exacerbate existing societal biases. And this becomes significant as these systems are increasingly being used to allocate basic resources and opportunities such as credit, housing, and employment. So in this paper, we discuss recent computer science research around a phenomenon called model multiplicity, and consider its implications for law and policy. So you can go to the next slide, please. So there's a common assumption about AI models and algorithms in general, that there exists a unique solution to any given problem. People kind of assume it's like solving an equation. There's just one best model. And this idea suggests that trying to reduce disparities will involve trade-offs with performance. But it turns out this isn't really true. In practice, no model is going to have a perfect level of accuracy. And given some level of error, there are many different ways of distributing error across a model's predictions. So this is a very simplified example, but it shows that we can have different models with the same level of accuracy, 90%, but spreading that error around across the population in different ways. And this can have important ramifications for equity. So next slide, please. If you consider these two models that we have illustrated here, I actually can't quite see the one on the right side, but it's basically the same set of observations with the line drawn in a different way to represent a different model. Both of the models have accuracies of 80%, but the model on the left has an accuracy of 100% for men and 60% for women. And the model on the right has equal accuracy of 80% for both groups. So if we scale up this observation and consider data sets that have hundreds of thousands or millions of points, there are countless models for any given application which have the same accuracy, but distribute error differently, and that can result in different amounts of disparate impact. So when we have models which are equally effective, but less discriminatory than a given model, for example, an already deployed credit underwriting model, we can say that there exist less discriminatory algorithms, what we call LDAs. The important point is that for any given algorithmic system that is used in practice, it's almost certain that there exists a less discriminatory but equally effective algorithm. And we can go to the next slide, please. So model multiplicity, this phenomenon has significant ramifications for law and policy, and in particular for disparate impact doctrine, which is the main legal tool that people have been looking to try to combat algorithmic discrimination. Disparate impact doctrine typically proceeds in 3 steps. First, a plaintiff has to show that a policy or practice has a disparate effect on a disadvantaged group. Second, defendants can defend from liability for disparate impact by demonstrating a legitimate business justification for the practice. And then third, a defendant may still be liable if plaintiffs demonstrate there's an alternative that is less, that would have less disparate impact but would serve the same business ends. In other words, the concept of a less discriminatory alternative is already recognized in the law, but it's assumed that plaintiffs should have the burden of proving the existence of that alternative. We think it makes no sense to say that a defendant has shown that an algorithmic system is justified or necessary if an equally accurate model that exhibits less disparate effect is available and can be discovered with reasonable effort. And that's exactly what model multiplicity shows. Next slide, please. So our core argument is that entities that use algorithms should be required to make a reasonable search for less discriminatory algorithms before deploying these models in critical domains like credit, employment, and housing. Model developers are in the best position to find less discriminatory algorithms, and the very process of developing a model through the machine learning pipeline inherently involves exploring and testing of alternatives. And we think that consideration of disparities should be included in that exploration and testing process. So our basic argument is that the law should recognize a duty to search for LDAs in at least 2 ways. First, under disparate impact doctrine, defendants should have to show as part of their burden of justification that they undertook a reasonable search for LDAs before they implemented a model that has disparate impact on disadvantaged groups. And second, any new regulatory governance of AI in areas where entities are designing tools to be used for things like credit, employment, and housing, in those areas, the AI developers should be required to undertake a reasonable search for LDAs as part of complying with that process. So the next slide. Broadly speaking, then, there are 4 key elements or processes that entities should have in place. In the interest of time, I won't go through each of those individually, just leave them on the slide. But I just want to close by saying that this idea of requiring search for LDAs is, we think, a really important part of the process, but it's not a magic bullet. Other aspects of these models still need to be scrutinized, such as quality and representativeness of the data, questioning how a problem is formulated, and so on. There may be some models that are so problematic, or some decisions that are so sensitive, or some situations where the risks are so great that these models should not be used at all. But searching for less discriminatory alternatives is one important tool that can help to reduce the harmful discriminatory impact of algorithms where it is otherwise appropriate to use them. So thank you again for your time.
Thank you so much. That was helpful and it really outlined some important points when it comes to the bias that we can see and will see and may affect how AI works in our financial markets. Ms. Bent has very graciously ceded her time due to some of the time constraints today. So we'll move to Mr. Hart, who will give us some background on what we really need to understand from a technological perspective about AI and machine learning in order to think about shaping future policy. And as somebody who works a lot with technology and thinks about how to translate it to policy, I do think this is an incredibly important point when we think about how to mitigate risk and think about what policy should look like moving forward.
Hi, thank you for having me here today to talk about how AI works so that we can better understand the risks and how to address them. Just to start off, I wanted to draw a distinction of machine learning is a cluster of technologies that has been around for decades, including used in financial markets for decades. But the really revolutionary thing that's happened within the last 15 years or so is the development of things called deep neural networks. So can we get to the next slide, please? So shallow neural networks have been around for a long time also, but they weren't particularly successful. What basically it is each of those circles is assigned a value, and each of those lines is the value that you multiply the value for the circle and add them all up. And when you just have 2 layers, or 3 layers, so an input layer, a middle or hidden layer, and an output layer, it's not particularly successful. But we found out that once we start stacking a ton of these together, it turns out that it is actually very successful. And just as a note, the theoretical foundation for this has been around for a very long time, but the computational power necessary to actually compute these and to train the weights for these has really only been around recently due to huge advancements in graphical processing units. Can we get to the next slide? So just a quick explanation of how the computer actually does it. So we tend to actually like to think about these in terms of these neurons. So that's an input layer of neurons on the left and an output layer of neurons on the right. And then the lines that connect them are connections between the neurons, and we assign those weights. Those weights are trained, and the training is actually the thing that's very computationally intensive. So like some of the large language models that are open source, I can actually run them on a laptop, but there's no chance that I could train them on my laptop. That is the very computationally intense part. We multiply, but we actually represent these as matrices, which are just rectangular collections of numbers. And that tells us how to do the multiplication and additions in a way that computers can do very, very efficiently. Can we get to the next slide, please? After that, we have to introduce some sort of nonlinearity, it's called. And these are 2 of the most common things that we use for them. If anyone is a chess player, the left is actually how ELO scores were originally computed. And these things, again, have been around for a very long time. It's just a matter of the computational power is relatively new. So we just take these, that gives us the weights for the next layer of neurons. We send those to another layer of neurons and to another layer of neurons until we get an output layer. Also, we call these neurons because they were originally inspired by brain neurons, but they function on a very different level. They're very differently. So now that we have just kind of the very foundation of how all of these deep neural networks work, which is really the technology that has been revolutionary in the last few years, I just want to give a very quick overview of how ChatGPT and all of these generative large language models work. So the first thing is you give it a prompt. It breaks those prompts down into subwords. So for example, speaker, it would break into speak and That's called tokenization. For the rest of this conversation, I'm just going to refer to them as words. It's easier on the conceptual level there. And it embeds those in a meaning space. That meaning space is trained so that it associates words that come up more frequently together as closer. So for example, the word koala comes up more often with Australia than it does with submarine. So the vector or list of numbers that you use to embed koala is closer to Australia than to submarine. Also, you have to teach it something about the position in the sentence because word order matters. And to do that, we actually just create another vector and we use sines and cosines, just like you guys learned in trigonometry in high school. And we add those 2 vectors together. And then we send that through a series of neurons or encoding layers. Those encoding layers, that first encoding layer teaches that word to pay attention to its relationship to every other word in that sentence, or however long your prompt is. You then send that through another layer. That teaches it to pay attention to how the other words are paying attention to the words in the sentence. You send it through it a ton of times, and that teaches it the context. So just to give a quick background, GPT-3, which is at this point very far behind the state-of-the-art large language models, had 96 encoding and decoding layers to teach it the context. Then, in the end, once you send it through a bunch of encoding layers, you send it through a few decoding layers, and it will give a prediction for what word is most likely to come next. So for example, up there, if the input is the cat in, the most likely word, just based on our general experience, is the for the next word. Could also be a. So it assigns, say, 85% chance for the, 15% chance for a, and then you use a random number generator to pick which one it's going to say. For this example, then you take your new sequence and feed that all the way back to the start. So in this case, it chose the, then it's got a new prediction distribution. Hat, in this example I gave, is 80% chance, house as 10, and tree as another 10% chance. So it could turn this into the cat in the hat, the cat in the house, or the cat in the tree. I think a very important just theoretical foundation here is that these generative AIs are at the heart just predictive AIs with this extra layer on top. And predictive AIs have been something that have been in some sort of consciousness for a long time, including in financial applications. There's obviously a lot more that could be said about that, and if people want to talk more later, I will be very happy, but in the interest of time, I'll end there. Thank you.
Thank you so much to our great panelists on this. I think we are just scratching the surface of some of the issues that we may really need to tackle and the risks on AI and machine learning from a regulatory and policy perspective. So appreciate the discussion, and thanks so much for the opportunity for everyone to be heard here today.
Thank you. Thank you, Yesha, Pauline, Eamon, and Rebecca. It was nice to have this very rich discussion that was slightly not exactly within sort of the CFTC markets, but also I think sort of provides you with a broad view of all of the issues that may arise in the context of AI in different scenarios, and also just to give us some very technical background on the technology itself. So thanks very much. Okay, we'll turn to our fourth and last panel. In that panel, we're asking the question, what do we anticipate in the near future? Our panelists include Purvi Maniar, General Counsel at Falcon X Holdings, Natalie Tynan, Associate General Counsel, Head of Technology Documentation Strategy at the Futures Industry Association, Robert Mahari, doctoral candidate at Harvard Law School and the MIT Media Lab. This panel will be moderated by Gary Kalbau, Deputy General Counsel and Director at ING Financial Holdings. Gary.
Thank you so much, Tamika, and thank you to all the panelists that are here today. We have a good sense of some of the risks that we're facing from the last panel. And I want to actually continue, in a sense, that discussion that we had in the last panel, looking at some of these risks, and ask you, Robert, if I'm designing some application or I'm utilizing this technology, what do I have to think about in some future use case in terms of compliance and other elements?
Thank you so much. Thank you for having me. So I'll give a little bit of background on kind of what I do and then try to answer your question. So I was able to kind of find this intermediary degree to create kind of this new joint degree between Harvard Law School and MIT. And really the focus of my research and the group that I'm in is on thinking about approaches to AI risks and other things that are grounded in both technology and in law. And so we've been doing a lot of work around kind of automating aspects of legal practice, automating aspects of compliance, all these kinds of things. And I think that's revealed a couple of key themes about like how do we design these models, how do we prevent risks that might be relevant to this discussion. And so specifically, one thing to keep in mind that distinguishes AI risks from, say, privacy risks is that it's not obvious that the harm of AI risk scales with size, right? So if you have privacy risks, you need to have a certain amount of data in order to have like a massive data leak that damages the economy. With AI, the barriers to entry are relatively low. We have open source models that you can run on your own laptop. And so that makes us think about these risks in a slightly different, maybe more proactive way. And specifically, we've been excited and interested in a concept that we call regulation by design, where we try to embed regulatory objectives into the design of technical systems themselves, rather than trying to have a liability framework or some sort of ex-ante risk prevention framework. Now, of course, this doesn't work for everything, but since Commissioner Johnson mentioned a couple of kind of key principles, I'd say that there's promise in many of these areas, spanning from kind of oversight controls that can be embedded into systems, explainability, and testing and monitoring that kind of the systems can do by themselves. And so once you deploy them and whoever uses them, these controls stay there. So with respect
Robert,
to—
can I just ask you something on that?
Please, yeah.
These are ex ante then? These are before the model's deployed. They're built into the model? Is that?
That's right. So there's kind of foundation models like the ChatGPTs and the Llamas of the world. And that seems to us to be the place to intervene, right? Because it's fairly difficult, fairly expensive to train those models. The entities that are doing that training are entities that we can reach. They're, for the most part, located in the United States. So that seems to be the place where we can intervene. They then provide API access or some sort of secondary access. But if we can kind of put the controls in at that stage, e.g. have a model that can't produce copyrighted material, things like that, then it won't be able to produce copyrighted material kind of later down either. Yeah.
So I want to ask Purvi, to that extent, I know you have some current use cases, and when you look at, for example, looking at Commissioner Johnson has enunciated a detailed risk framework in a previous speech at the New York City Bar and in the discussion this morning. How do you approach it when you're deploying something new? What are some things we should think about?
Yeah, thank you, Gary, and thank you, Commissioner Johnson and staff for having me here today to talk about this topic. It's complex, right? So I think actually Eamon did a great job talking about how, and the first panel too, use cases for AI have existed for a long time in financial services, right? It's just that the technology itself has evolved. And so how we can incorporate it into what we do has changed, right? So a lot of what we heard about the use cases historically used in financial services focused on one task, right? So one set of inputs, one task, one output. And I think what's changing, and it's changing alongside our markets as well, and our regulated markets are becoming, right, they're faster, they're more efficient, they're more transparent, is that the amount of data that these models can now ingest and analyze can result in much more real-time outcomes. And when you think about that in the context of like risk management, for example, right, a real-time analysis of what market risk looks like and market stress looks like can actually enable preemptive action, right, in those types of scenarios. And when you think about that in the context of like stress testing and scenario analysis, being able to use these models in those contexts where they have access to the data that exists in this space and is being trained for this type of data is transformative for sure. Similarly, like regulatory compliance, just another easy area, right? Proactive regulatory compliance is hard to do. It's labor intensive, right? But as you can incorporate more information, more data, and models that allow you to actually process that type of data, you have situations where you can actually get outputs that are A, real time, and B, you can transform your process so it's responsive to those situations in real time, right? Which I think is actually really important when it comes to especially like trade monitoring and surveillance.
Can I ask you about that, Purvi?
Yeah.
So Because that seems to be the challenge, and I think Robert Mahari was talking about that to some extent. Like when something's real time, how can I do active compliance monitoring? Does most of it need to be front loaded in the design, or?
I think so, right? I think it has to be front-loaded based on just basic requirements from a regulatory perspective, but then also front-loaded with the type of training that actually Eamon was talking about, right? So it's fit for purpose, not just that it can be used, but it's used in the right context. And I think a really simple example of this is, right, you can have an AI process that can generate an algorithm that is a trading algorithm. And on the other side of it, you could have an AI surveillance algorithm, right? And they both accomplish independent functions that are meant to be checks on one another or interact with one another, but how you train them, the data sets that they use is really what's important to consider. The CFTC has existing rules, right, for how swap dealers like us or other regulated entities should think about new products in this space. And I think AI is a ripe area to go through that type of new product analysis using some of the principles that Commissioner Johnson mentioned in her opening remarks today.
Fantastic. Thank you so much. And Natalie, I haven't forgotten about you. I just have one question for Robert first, if I may. Robert, I want something tangible I'm looking for in terms of how I have this front-loaded compliance. And maybe in the context of anti-money laundering or something like that. Like, is there a use case you can provide for how this could possibly work?
Right. So we wrote a paper, AML by design, anti-money laundering by design, and that was kind of inspired more by digital currencies and the opportunities that you have to embed kind of code into a digital currency. But that code that we were talking about was, at least partially AI related, right? And so we were interested in thinking about, can we, and this actually goes back a little bit to this LDA concept in the sense of there are tensions in anti-money laundering, right? So you have privacy, you have financial inclusion, you have compliance costs, and it's not obvious that the way that we've designed the AML kind of regulatory framework right now does the best possible job at navigating between these competing trade-offs. And so we were really interested in seeing whether we could embed different and competing regulatory priorities into an AI system that does, for example, suspicious transaction reporting while measuring things like financial inclusion, while keeping track of like, well, what data are we collecting? Are we collecting the minimum amount of possible data? Has data already been collected elsewhere that we can use? And things like that. And so it just, I think, generally gives regulators a new ability to think about intervening in markets, right? Because we have, and hence kind of regulation by design, right? Like we can embed the objectives that we care about into the systems that are being deployed rather than intervening ex post. And as things become faster and faster and more real time, that's probably not just an interesting option to have, but a necessity, right? So, thank you.
Thank you very much. And Natalie, I want to ask you, we had the request for information. We've had a lot of guideposts and thoughts that, I mean, Commissioner Johnson candidly has been the primary thought generator on this topic in the context of the CFTC. Where are FIA members? Where is your membership trending on all these issues?
Sure, yeah. So I want to start by saying that our members, I think, were very excited to be consulted by the CFTC on this before any proposed rules come out. I think we feel like it's a valuable discussion to have at the forefront, and we welcome that opportunity. We have formed a working group of our members that I'm sure, as most of you know, comprises exchanges, FCMs, other regulated entities, vendors in the space to respond to the RFC. And while the RFC itself is not due for another couple weeks, I would say the preliminary trends that are coming out of those conversations so far are basically three things. First is that I think there's FIA believes AI is either currently and or will be used in the future in three basic areas. The first is trading strategies, the second is hedging and risk management, and the third is compliance and risk tools. And as others have said today, our members believe that the use of AI in our markets is not new. It's been around for many years, and examples of that would include things like back testing, as well as communications review and production for regulatory inquiries. And I recognize, as others have here today, that some of that really, particularly the communications review, right, probably falls more in the category of machine learning than it does generative AI. But I think it's worth worth pointing out nonetheless. The second point I would say is that we believe the focus of the CFTC's efforts and any regulation in this space should be on the results and not the tool that's used to get there. So said another way, we believe that the CFTC should focus on the conduct that they wish to prohibit and not the tool by which someone might engage in that conduct. So just to sort of pull a random example, let's say certain CFTC registrants are required to file CCO annual reports, right? We believe that the CFTC should, and indeed already does, regulate what they would like to see in that report, right? The substance of what they would like included, and we don't believe that it's necessary to regulate the tool by which they get there, whether they're using AI or not, to prepare that report. The standard for
So
what
Natalie,
ultimately
you're
needs,
saying it should be technology agnostic? Is that what you're saying?
correct. Yeah, that would be another way to phrase it. And then just the last thing I would say as a theme that I think is coming out of our members' comments so far is that we're aware, as an earlier panel covered, that there are many regulators, foreign and domestic, that are looking into this, right? And so we would like to encourage harmonization amongst those, recognizing that many of our members are subject to the jurisdiction of, a wide variety of those regulators.
Okay, well, thank you very much, and I thank my panelists. I think we're a little bit over on time, but hopefully we're getting back on.
Well done. Thank you very much. So that wraps up the panel discussion part of this meeting. And next, we're going to move to subcommittee discussion. We want to make sure that the members of the Future of Finance subcommittee, that they have an opportunity to share their reflections and give us their perspectives on some of the issues and points that have been raised so far. And to facilitate that discussion, I'm going to ask Petal to take over.
Okay, sounds good. Okay, so just to get started, for the members of the subcommittee, you've heard quite a few things today about AI and financial markets, about the regulatory aspects, about risks and the future. Just to kind of start the conversation off, is there anything that's standing out to you personally as an area in which you think we may need to engage, or anything that's standing out, period, from a CFTC perspective? Just want to see if anything's like bubbling to the top. If not, I certainly have some thoughts of my own, but I want to start there. Anyone on the subcommittee who's online or here in person who has anything that's standing out to them as being on fire, burning issue?
Yes, I see Ty Slocum.
Hi, great. First, thank you so much to Commissioner Johnson and the CFTC staff and all of the panelists. This has been incredibly illuminating, and I'm very grateful for all the different perspectives and information. I think one of the things that was sort of a significant takeaway for me is the relative concentration of vendors providing these AI services, because there's only, as some panelists noted, the resources required to perform these sort of high-level data processing activities is really concentrated in just a few firms, and that appears to present systemic risk and market concentration concerns. And as commodity derivative markets become more dependent and reliant upon AI to perform all of these different tasks in terms of trading and hedging and compliance and other services, I think ensuring that the CFTC has clear regulatory jurisdiction over potential systemic risk and market concentration issues with these vendors, I think is going to be important.
Yeah.
Those are my 2 cents. Thank you.
Oh, excellent. Any other thoughts from the floor, the subcommittee? Okay. As you gather your thoughts, I do think that a good place for us to start is the 5 points that Commissioner Johnson outlined earlier in her speech. And I think those 5 points are consistent with a lot of the dialogue that we see internationally across other regulators. Those 5 points, just to jog your memories, we're first dealing with governance. right, the governance of AI, this might be a space in which we may want to make some recommendations or do some activity. Secondly, explainability, right, an oft mentioned important issue. Thirdly, bias, right? Fourthly, testing and monitoring, right? So how is that accomplished, et cetera? That could be an area for us to lean in. And lastly, we've heard so much about data and data controls, right? Being able to meaningfully engage on the data that's coming into these systems in order to train them, et cetera. So I think those 5 were outlined in the speech, and maybe of those 5, does that sound like the right list? Any of those 5 you feel particularly strongly about? Anything you'd add to that list? Just let's see what's bubbling up after all of these conversations you've heard.
Kevin? I think Kevin would like to provide some reflection.
Thank you. I was just going to say, I think some data collection, at least voluntarily, might be helpful. We've heard some useful data points about AI uses in finance from Jessica and from others, but in particular from the CFTC audience, not just what they're doing on AI, but what they're doing in terms of some of these risk management techniques and so forth. It would be really interesting to have a more solid foundation for what's already happening and not, and that could probably be done in some way that's sufficiently anonymous that firms would be comfortable.
Yeah. That's a very interesting concept because the RFC is definitely asks for comments, but it's not a comprehensive survey, right, in terms of every single entity. Or David, did you have a thought on that?
No, you're right. I mean, it's not a required supervisory document, so it's asking for comments. But I mean, I think to the speaker's point, to Kevin's point, what we're trying to do is understand from people both how they're using it and what risks are in it. And I think at this stage, it's a question of developing our knowledge sufficiently that the supervisory process can be guided by the responses. So it's part, I mean, and it's not, we have ongoing supervisory work, as I mentioned. So it's part of the process of educating ourselves, and the supervisory work goes alongside it.
Yes, so it sounds like then a survey then would be a helpful addition then to what's already happening since it's not a mandatory thing with the RFC. It's an interesting point. Any other points, areas you think are important? Because this will then lead into the direction that that we take, Gary and I, to develop some initial language the subcommittee can then opine on further. So here's your opportunity to help direct that.
Thank you, Petal. So one of the ideas that stuck with me was this concept of explainability, and also what is different within AI that we haven't dealt with in the context, for instance, of reviewing algorithms, trading algorithms, or putting together trading algorithms and making sure that they comply with existing regulations. And I thought that the talk about deep learning networks was illuminating in that it helps us understand how many layers there are, which in my view could have, or maybe that's a question for the panel, could affect explainability. The more layers you have to go through, the more complex explainability may be, and then you're not talking to a human coder, but maybe you're talking to an AI coder. And so how do you interact with AI in that context, and how does that affect our thinking of the issue?
Great point. Yes, please, Mark.
Hi, thank you, Petal. Mark Hayes, Americans for Financial Reform. I want to thank the Commissioner for today's presentations. It was really illuminating, as Tyson said. Still exploring this space, but I think 2 things stood out for me from today's presentations. I think speak to the list you enumerated, and I'm still working out how they fit in, but I think they're relevant. I think the first, I was really struck by Professor Kim's presentation and the demonstration of LDA. I think it speaks to a broader question around what I'm going to call, and maybe the right term or not, sort of social utility, which is to say, when AI technology is deployed, who are the beneficiaries of that deployment? How are the benefits and risks distributed? I think using that example, you can see that an AI may function exactly how it's supposed to, but might end up generating adverse outcomes. And so I think thinking about who at the end of the day benefits from that deployment is a critical question, and we need to think about it both in an abstract way, but also in kind of a real world way. You know, who are the actual market participants, the people who are not exposed to the tech, not embedded in the industry, but nonetheless are impacted by it. I think the other, and I think that speaks a little bit to how explainability, governance play into evaluating those outcomes. I think the second thing, Professor Yadav's presentation, where she mentioned questions around, I guess I'd use the word accountability. If you deploy an AI and it involves irrational activity that generates fraud-like activity, at the end of the day, who's responsible? I think that speaks to accountability, which is, you know, sort of another facet of governance. And I think one risk that we see, or at least a concern we're engaged in, is if you deploy this technology and create a situation where either actors are able to sort of provide plausible deniability around their accountability for the programs, or simply no one can determine where accountability lies, that's going to create a lot of challenges in terms of the kind of accountability we need to make sure that if people are harmed, there is restitution and remedy.
Great point. So someone has to be on the hook if something goes wrong. It's a very common CFTC concept of keeping someone on the hook. That's great. Anything else you want to mention? Are you still up, Alessandra? Your thing's up? Okay. Anyone online? Okay. Okay. So we will take those thoughts. We will start to develop some language around it. And to your point, Mark, I saw a lot of adjacency with bias for your first point and governance for your second. So I think maybe we'll expand those to include those points. And so just for the subcommittee, in terms of the bare bones pragmatic aspects here, we need to get to work, just to be clear. And so Gary and I will start that process by having some initial writing, which will be turned over relatively quickly. And then you'll have some time then, probably not a lot, but some time, maybe a week or two, given the time frame, in order to take a look at broad recommendations. Okay, we're not going too deep, we just got started. So broad recommendations, and take a look at those, and then we'll have another meeting. This is a key point for the subcommittee. We're going to have another meeting to really opine on those recommendations. So you have a chance to review, we'll have a chance to discuss, but we are attempting to be able to speak to our parent entity, the MRAC itself, and they do have a schedule, so we're going to be very thoughtful about that. So just to make sure that those in the subcommittee are aware of that, probably today you'll get some sort of email or about planning our next meeting. Please do be very responsive to that, right? This is not the subcommittee for beauty alone, though you are very attractive, is also about the business subcommittee. So just, that's happening. Please keep your eye out for that. And then hopefully we can take all of this that we've learned today and create something that will help to push the conversation forward for the commission.
Thank you very much. Thanks, Petal, for your diligence. Really appreciate it. Well, that concludes our very thoughtful and enriching meeting today. I'd like to express how thankful we are for the insights of our guest speakers, as well as the thoughtful contributions of our MRAC members. Commissioner Johnson, just before we close, I want to turn to you and ask if you have any final remarks.
Thanks so much, Tamika. I want to thank Petal and Gary and the subcommittee members who, and my staff, who worked very diligently to move very quickly to bring our thoughts and this conversation together. Without your help, late nights, and tremendous engagement, we would not have successfully arrived here today. I want to just thank each of the panelists and moderators. So Alessandro, David, Kevin, Jessica, Lisa, in the first panel, Petal, who didn't acknowledge her own CFTC roots as Commissioner Sharon Bowen's counsel here at the CFTC not so long ago. I want to thank you, Petal, Jason, David, and Hen for the second panel. I want to acknowledge and appreciate Rebecca Reddig joining us from very far away offshore. And also, I think Yesha and Pauline were also traveling, and Dr. Hart for coming down to spend some time with us today. Finally, I'm grateful, Gary, for your leadership in the final panel with Purvi, Natalie, and Robert. What we're hopeful, as Petal mentioned, is that we can see action alongside our engagement. And so we look forward to continuing this conversation in the weeks to come.
Thank you, Commissioner Johnson. Again, a final thank you to everyone for attending our inaugural meeting of the Future of Finance Subcommittee of the MRAC. It's 11:27, and the meeting... No, no break. Just wanted to say that we ended on time, a little bit early. There is no break. This meeting is adjourned, and we'll start the next meeting of the climate-related market risk subcommittee promptly.
Sorry, Tamika. Hi, there are a few people who are shifting towards seats. No one need remain where you are, but those who are joining us for the second meeting, you may have an actual seat in the front of the room, so please be sure to come up. I guess somebody better say 3 minutes.
Yeah. Yeah. Okay. We're going to take a short break. We'll be back in 5 minutes. so I guess it's down. Okay, we're going to get started. Good morning. As the alternate designated federal officer for the Market Risk Advisory Committee and the MRAC Subcommittee on Climate-Related Market Risk, it's my pleasure to call this meeting of the MRAC Climate-Related Market Risk Subcommittee to order. Before we begin this morning's discussion, I'd like to turn the floor over to Commissioner Kristen Johnson, the sponsor of the Market Risk Advisory Committee, for opening remarks. Commissioner Johnson.
Thanks so much, Peter. Good morning. I'm excited to welcome many of you to this meeting, and I'm grateful to those of you who are joining virtually. The topic that we'll cover for today is one that I know a number of stakeholders across public and private spaces have labored, working diligently to bring forward thoughtful ideas for regulation, guidance, and policy. Last fall, I had the opportunity to offer two keynote addresses, one at the Atlanta Federal Reserve Bank and one at the Dallas Federal Reserve Bank. And in each of those comments, in each of those keynotes, I offered what I believe is a preview for some of the work streams that this subcommittee would take up. I shared that it is imperative that the CFTC do its part to address the issues arising regarding climate-related risks. And we marked as a first step, or a step in the right direction, the voluntary carbon offset credit discussion that we've had here at the CFTC through a number of initiatives. One is the Commission's recent proposed guidance, which marks a step in the right direction. Others include two convenings last year organized by Chair Russ Benham, focused on bringing forward a broad diversity of issues that directly correlate to climate-related risks, climate-related market risks. The guidance specifically comes against the backdrop of a request for comment to the Commission issued last summer. The request for comment prompted over 80 comments and, in fact, offered lots for the Commission to begin to digest and consider as we begin to consider regulatory intervention. With that having been said, there remains much work to be done, and admittedly, this is an evolving and complex space. There are deep and persistent concerns regarding the integrity, credibility, and lack of visibility in the market for carbon offsets. While the Commission's authority to introduce regulation in the context of this market is limited, the Commission has broad authority to address fraud and market manipulation in the spot market. There's mounting evidence to suggest that carbon offset markets are overcome in some instances by fraud and misrepresentation, much of which has been very publicly exposed by news and media outlets, and including a very recent article in the New Yorker focused on the great cash for carbon hustle. Illustrations from that specific article demonstrate the need for core principles in the context of carbon offset projects in this area of finance, of sustainability finance. Is certain that if the market for carbon offsets is meant to remain, it must begin to conform with respect to regulatory expectations. The guidance we issued most recently offers, as I said, a first step, but I'm hopeful that this committee will take up the mantle and help the Commission begin to translate principles that specifically address transaction reporting, secondary market regulation, accountability standards for intermediaries, business conduct standards, and standardized documentation, among other appropriate guardrails. These principles are critical to creating a robust and well-functioning commodity derivatives market. I'm pleased to say that MRAC's Climate-Related Market Risk Subcommittee stands out as a first-of-its-kind effort in the financial markets sector to accomplish this critical work. Today, we'll hear from several panels of invited guests from across the industry, on a variety of topics, including market integrity, disclosure, transparency, and enforcement, market design and intermediation, and product design and reliability. I will leave to ADFO for the Climate-Related Market Risk Subcommittee, Peter Janowski, the honor of introducing each of our distinguished guests and speakers. I'm hopeful that at the close of today's presentation, we will have not only learned a tremendous amount, but begin the process of outlining the types of recommendations we might put forward to the Commission as the Commission considers a regulatory approach for these markets. Let me express my deep appreciation to our chair, Alicia Crichton, to DFO for the MRAC, Tamika Bent, ADFO for the MRAC, Peter Janowski, and Peter also serving, double hitting in this context, as ADFO for this subcommittee. Thanks so much.
Thank you very much, Commissioner Johnson. Before starting our discussion, there's just a few logistical items that I'd like to mention to the subcommittee members and the invited speakers. Please make sure that your microphone is on when you speak. The meeting is being simultaneously webcast, and it's important that your microphone is on so the webcast audience can hear you. If you'd like to be recognized during the discussion, please change the position of your place card so it sits vertically on your table, or raise your hand, and we'll be able to recognize you to give you the floor. If you are participating virtually and would like to be recognized during the discussion portion for a question or comment, or if you need technical assistance, please put a note into the chat, and we will, my colleague Rebecca Lewis-Tierney will be monitoring it, and she will alert me if there's any problems or assist you. Please identify yourself before you begin speaking and signal when you're done speaking. Please speak directly into the microphone for optimal quality on the webcast. Unmute your Zoom video before you speak and mute after you speak, please. And please only turn on your camera when you're engaging in discussion. And if you're disconnected from the Zoom at any time, please close your browser, enter the Zoom again using the link that was sent to you previously. One last note, the Future Finance Subcommittee of MRAC met directly before this meeting. Some of the members and invited speakers remain in the room and on the live stream. You're of course welcome to stay and watch, but we ask that participation in this portion of today's meetings remain limited to members of the climate-related subcommittee, climate-related market risk subcommittee, and invited speakers. With that said, all three of our panels today will be focused on the voluntary carbon credit markets and the issues that those markets face. Our first panel will be examining market integrity, disclosure, transparency, and enforcement. Members of the panel are Steve Supan, who is an analyst for the senior policy analyst for the Institute for Agriculture and Trade Policy, Holly Perrin, lead counsel for Environmental Defense Fund, and Jessica Garcia, senior climate finance policy analyst for Americans for Financial Reform Education Fund. I will be monitoring the panel. I'm Peter Janowski. In addition to MRAC ADFO, I'm a trial attorney for the CFTC's Division of Enforcement. Steve, I believe, is having some issues joining the Zoom. He was supposed to attend virtually. So we'll start with Holly and Jessica. Holly, as Commissioner Johnson mentioned, there's been significant media attention in the last 6 to 12 months about carbon credit projects not turning out to be exactly what they're billed to be. Do you view this as a science issue, a disclosure issue, some combination, or a deeper problem about present in the voluntary carbon markets?
Thank you, Peter. And thank you, Commissioner Johnson, for your continued engagement on this critical topic. Many of the integrity issues plaguing the VCM stem directly from standards maintained by the most prominent certification bodies by volume. These standards rely too heavily on ad hoc statistical analysis, outdated methodologies that validate procedures rather than results, and a program structure that incentivizes producing as many credits as possible. For nature-based programs and cook stoves, the primary source of overcrediting risk tends to flow from the calculation of baseline rates. There's momentum to support approaches that better reflect the complexities of predicting carbon saved from forest loss with innovations such as dynamic baselines that change through time, analyses backed with time series of satellite images, and data-driven approaches for selecting jurisdictional reference areas that actually resemble the project area. New initiatives from the ICBCM, the Integrity Council on the Voluntary Carbon Market, and the VCMI, the Voluntary Carbon Markets Integrity Initiative, are standardizing these quality benchmarks on both the supply and demand side, which can be translated across a variety of different carbon projects. The ICBCM will begin tagging credits with their integrity label early this year. The first 2 CCP labeled credit certifying bodies, in fact, will be announced next week. These processes, of course, will need to be improved to maximize their impact on carbon credit quality, but establishing a single set of integrity standards will be a really big step towards addressing both the science and disclosure issues you mentioned. And on a more meta structural level, many of the problems we characterize as quality issues that you've potentially heard and seen in the media result from an adverse selection problem facilitated by the fact that a huge percentage of credits are sold OTC. I cannot stress enough the importance of a public market that has low friction, high transparency, and is perceived as a safe place to store and transact assets for driving improvements in environmental integrity and market integrity. A robust futures market can play a critical role in creating a reference price for carbon buyers and sellers, and the power of that price signal itself to drive GHG emission reductions can't be overstated. So I think I'm proposing that market integrity will drive environmental integrity, and that perhaps it's a market integrity issue as well as a science and disclosure problem. While the task force on scaling voluntary carbon markets did identify credit quality as a primary barrier to scaling the VCM, the core carbon principles and attribute taxonomy were only one of 6 topics for action, an incredibly important topic, as borne out by market performance last year, but still only one of 6. 2 of the other topics for action address the demand signal and are the subject of the VCMI credit claims guidance and greenwashing rules in California, the EU, and potentially the FTC green guides. I think EDF suggests that this subcommittee may find rich fodder for continued activity in the remaining 3 topics proposed for action: market intermediaries, market infrastructure addressing trade, post-trade financing data, and market integrity assurance. As a starting point, I would encourage further discussion around proposals in Commissioner Johnson's remarks accompanying the VCC guidance and Commissioner Goldsmith-Romero's remarks of March 2023 to the ISDA Forum, which include proposals to create a new category of environmental and climate-related products, consumer education, assertion of legal authority, and heightened review for self-certified environmental products.
Thank you, Holly. With a background understanding of sort of the CFTC's existing jurisdiction in the market, what enforcement avenues do you believe the CFTC should focus on to achieve the goals of market integrity?
Yeah, I think the formation of the Environmental Fraud Task Force was a great step and really in line with other jurisdictions that are seeing high trade volumes in EUAs and carbon credits. At this point, right now, in early days, I would recommend that that task force focus on the core characteristics of a credit and allow the market to address issues of quality around specific projects and project types. There is always going to be a huge quality variation because crediting programs and projects are built, maintained, and financed by humans in a range of jurisdictions across a variety of project activity types, each with different characteristics and scientific and social risks. So I think we can let the market solve for that variation with price and risk adjustment mechanisms. That said, there's absolutely low-hanging fruit for enforcement right now around investments, even well-intended, valuable conservation investments, billed as quantifiable credits that can be used to offset emissions and enterprise or product GHG footprints that actually lack the basic hallmarks of credits, that they're quantified using an approved and standardized quantification method, verified by an accredited independent third party, and tracked and traded in a transparent registry. These 3 criteria that I'm articulating really dovetail with the quality, inspection, and delivery point elements identified in the CFTC's proposed VCC guidance. So well done there. And I will also say that one very rich area for fraud in the market we hear about anecdotally is around social safeguards and benefit sharing. Credits are frequently sold at a premium if they include co-benefits for local communities or vulnerable groups in the project area. For obvious reasons, this is an attractive area for buyers motivated by consumer acceptance. The co-benefits are unfortunately frequently illusory. Promised investments just aren't made and maintained, and tracking is difficult or just not done, I think, due to the somewhat qualitative nature of the co-benefits. And I think in addition, the experience with the EU ETS demonstrates that carbon credits can and will be subject to all the traditional forms of white-collar crime.
Jessica, turning to you, one of the areas that has been pointed at in terms of concerns about the voluntary credit markets is the lack of understanding of what exactly is in the credits themselves. What has been done to address disclosure and transparency issues in these markets thus far?
To start, good morning. I want to recognize and appreciate the Commission's attention to voluntary carbon markets and of MRAC for exploring its specific ties to market risk. I also believe it is critical that the Commission and advisors look at other climate-related market and prudential regulatory priorities within CFTC's jurisdiction. VCM integrity is a small slice of the overall climate-related financial risk facing these markets. Regarding VCMs, alongside our partner organizations, we have previously recommended that the Commission generally disallow carbon credit derivatives trading unless and until the integrity challenges within the underlying markets are reasonably resolved. Instead, the Commission has chosen to provide guidance to designated contract markets. This action, while important, is a small step in dealing with the persistent problems within the VCMs, which will require further action from the Commission, Congress, and other federal regulators to address. I want to highlight two recommendations for commodity characteristics that were not listed in the proposed VCC derivatives guidance. The final guidance should include leakage risk as separate from additionality and permanence under quality standards. Additionally, the Commission should be clear that a DCM must consider whether a crediting program has implemented social and environmental safeguards, as Holly mentioned. Those safeguards are material terms and conditions and required by most reputable private sector and multinational development initiatives to improve the chances that finance projects will not be undermined by violations of human rights, land rights, and labor rights, all of which could decrease investor confidence and result in a decline in the value of carbon credits. Getting back to your question, Peter, disclosure requirements or recommendations for any aspect of VCMs proposed by any government or standard-setting body should be considered by this subcommittee as pertinent to market risk. This subcommittee should engage with the Department of the Treasury, particularly related to its published principles for net zero financing and investment. Those principles note VCM challenges and make it clear that any voluntary use of carbon credits should be accompanied by sufficient detail on the nature and integrity of those credits. California Assembly Bill 1305, which was signed into law in October 2023, focuses on voluntary carbon markets disclosure. Any entity doing business in California, regardless of revenue, must disclose detailed information regarding their marketable voluntary carbon offsets on their websites. Our organization submitted comments this month to IOSCO's proposed good practices on VCMs as well. In its consultation report, IOSCO acknowledged that many offset projects are failing to deliver promised emissions reductions, and some carbon credits may amount to little more than greenwashing. IOSCO also says authorities with enforcement power, as mentioned, can play a significant role in preventing fraud, protecting market participants from misleading claims, and instilling greater confidence in the integrity of the VCMs. Finally, just last week, the SEC promulgated its final rule on climate-related financial risk disclosure from public companies, including extensive disclosures around carbon offsets usage and expenditures when they are a material component of a company's plan to achieve climate-related targets or goals. The SEC finds that this information is pertinent to market risks, and thus disclosure is valuable for investor protection. So too has the CFTC explained the importance of similar details as commodity characteristics that DCM should consider.
Thanks, Jessica. Steve, I want to turn to you. The concept of carbon credits have been around for a long time now, but the understanding of climate change continues to evolve considerably. One of the potential issues with the carbon credit market is confidence in the science and math that's backing up what the credits stand for. What do you view as the key challenges that the market faces on science and measurement of these carbon credits? And please unmute. I believe you're still muted.
First, I'd like to apologize for coming on late. I was writing and got confused about the time zones. So in response to your very good question, beginning in 2021, the Intergovernmental Panel on Climate Change and Climate Data Modelers reported a growing asymmetry between fossil fuel emissions and nature-based emission sequestration. And is characterized by Carbon Market Watch and Carbon Plan, a ton of fossil fuel emissions does not equal a ton of emissions reductions in terms of global warming potential. And as a result, it is very difficult to design robust emissions quantification and carbon credit methodologies that incorporate the state of science and climate modeling. For example, specifying the durability of carbon storage in the category credits and offset projects will become more difficult as the scale and frequency of emissions reversal events and erosion increases.
Steve, do you view the disclosure in self-certification documents as being able to inform those challenges at all?
So, the guidance to the designated contract markets should include in the self-certification documents an explanation of the durability of each category of emissions offset credits. The self-certification documents should include an explanation of the likelihood of reversals for each category of credits and the effect of on credit prices of reversals too severe to be compensated for by the buffer account credits of the registries whose credits compose the proposed voluntary carbon credit derivative listing. I would recommend that if the Commission finds the self-certification disclosures to be inadequate, it should consider a formal review of the proposed VCC derivatives contract. And lastly, I would recommend that these disclosures regarding durability and impact of reversals on the carbon credit price should be incorporated into the language of the VCC derivatives contracts.
Opening this up to the three of you as a final question, in what ways do you view the industry as having come together to address some of these issues, and ways that the industry and, for example, the subcommittee can work together to address them as well? Do you view any synergies there that have already happened and should happen in your mind?
Who would like to take this first?
Go ahead, Steve. You're on a roll.
Well, so I think it has to be said that the industry has come together very effectively to produce an evolving carbon crediting rule book and recommendations for how buyers of voluntary carbon credits are to use those credits. And as a result, the Commission is proposing to accommodate parts of the ICVCM rulebook to satisfy the Appendix 3 documentation requirements for demonstration of compliance with Core Principle 3. However, in order to minimize the burdens on crediting programs, the ICVCM decided to establish a platform for improvement based on the CORSIA eligibility standards. Now, CORSIA is a very diplomatically robust standard because it is developed by an intergovernmental body of 193 members. However, it is not a scientifically robust platform for improvement. And so the governance requirements of the ICVCM certainly have improved CORSIA, There have been some additional requirements, such as prohibiting the use of carbon capture storage credits that are used for fracking for enhanced oil recovery to qualify for the core carbon principle label. That's all to the good. However, there are issues that are very difficult to repair when you base your platform of improvement on CORSIA, however diplomatically robust. And I think that the Commission needs to do more due diligence, both on the ICVCM rulebook, and then also, as Commissioner Johnson has suggested in her comments on the release of the guidance, the Commission should consider developing guidance to market participants on the risk of trading in voluntary carbon credits, both in the cash markets and the derivatives markets. I think that's a very important next step, and I do think that the Commission would be well served to do a close reading, the ICVCM rule book, also in the context of the Article 6.4 Paris Agreement negotiations. In my reading of those negotiations, developing countries, the developing country hosts of the offset projects resisted being essentially assigned liability for any failure in the 6.4 requirements. And so I think that's going to be an ongoing issue. And even within the ICVCM rule book, they report that they are trying to consider whether there should be responsibility, if not liability, assigned to the developing country hosts in the event of reversal risk management failure. So I think those are some of the issues that the Commission needs to study more carefully.
I won't repeat anything that Steve said, but we'll just say that I agree with much of what Steve just covered. And I think when it comes to the industry, that the industry should engage, should scrutinize more integrity when it comes, as market participants are increasing their collaboration and alignment on standards. And then, I think for the Commission, in recognizing the extent of the problems within the underlying VCMs, the Commission should continue to caution all of its regulated entities in the strongest possible terms about, these well-founded concerns on transparency, credibility, greenwashing, and environmental injustice in the VCMs. The Commission should plan to engage in significant oversight to prevent fraudulent and misleading claims, market manipulation, and undisclosed financial risk. As the Commission finalizes the VCC guidance, it should closely monitor and bring appropriate enforcement action in cases of DCM's non-adherence to the core principles. Thanks.
I can address or describe some of the initiatives that EDF is involved in to sort of solve for VCM 2.0, which is the term that many in the industry are referring to the next iteration of the voluntary carbon market that represents higher market integrity and environmental integrity principles. And there are frankly lots of initiatives designed to solve for that. One big evolution is the kickoff of working groups at ICVCM that more specifically address market transparency recommendations and other market integrity issues. There's increasing scrutiny around the delivery points, the registries, to ensure that those are safe, secure places to store and transfer assets. The UNIDROIT and UNCITRAL legal nature of carbon credits working group is working to clarify the characteristics, the underlying qualities of carbon credits that will enable jurisdictions around the world to fold them into regulatory regimes to make private law transactions more predictable and investment, less susceptible to choice of law and uncertainty risks. And then I'll say that there are some shifts in some jurisdictions addressing this to address the permanence issues that Steve discussed by requiring clear disclosure of monitoring periods for various credit activity types, rather than moving towards more and more technical definitions of durability and permanence that are science-based. The monitoring period is tangible, knowable, and maybe more easily enforceable. Happy to discuss, ways CFTC can engage or build upon these activities at a later time.
Holly, Jessica, Steve, thank you so much for your engagement today. We really appreciate your work on this panel. And we'll now turn to our second panel, which will focus on market design and intermediation of the carbon credit markets. The panel members today are Katie Thiel, Senior Sales Specialist of Environmental Markets at the Intercontinental Exchange, Mike Aquino, Director of ESG at International Dairy Foods Association, Christian Schneider, Chief Strategy Officer at Nodal Exchange, and the panel will be moderated by Sonia Gibbs, Managing Director and Head of Sustainable Finance at the Institute of International Finance and a board member of the Integrity Council for the Voluntary Carbon Market. Sonia, over to you.
Good afternoon. Thanks, Peter, and thanks to Commissioner Johnson and the MRAC for convening such a topical session. Let me do a little framing to set us out on the international experience and standards setting around voluntary carbon markets, and I'll speak here from my vantage point on the board of the Integrity Council. As our chair, Annette Nazareth, herself a former SEC commissioner, has said, we've approached the creation and implementation of these core carbon principles, the CCPs, as a financial regulator would, to make it as easy as possible for regulators around the world to incorporate the elements of the CCPs as they deem appropriate. And given the challenges for voluntary carbon markets, as Commissioner Johnson just noted, there's certainly growing interest from our regulators, supervisors, and standard setters in how these markets are developing, including having the necessary guardrails and yardsticks for market integrity in place. If we don't have these, we will not be able to scale these markets, and that would be tragic. And clearly the CFTC has been very proactive in this space, not only domestically, but in the international arena, for example, in the discussions of IOSCO. I'd also flag here the guidance offered by the International Sustainability Standards Board, the ISSB, with regard to disclosures around carbon offsets usage. And I agree with Jessica, this is critical for investor protection. We've consulted widely to achieve international consensus around a global benchmark for these high-integrity carbon credits, reflected in our CCP rulebook. And I wanted to note that this is really subject to continuous improvement, this rulebook, including in areas like permanence, leakage, and social safeguards referred to by Jessica and Holly earlier. We have such a international cohort of scientists working with the ICVCM. It's really, really important to continuously improve. And we're now carrying out our assessments systematically with applicability to over 100 carbon crediting methodologies in the market, already impact and have a lot of support from the market, from buyers, and from governments. Programs that issue 98% of credits in the market have now applied to use the CCP label, and we're going to start announcing results in April. And exchanges, as you'll hear, are looking at launching CCP-labeled trading offers, and the CFTC's draft guidance on listing carbon credit derivatives is very much in line with the CCPs, and we encourage continued reference to them because so much work has gone into developing them. GFANZ as well, the Glasgow Financial Alliance for Net Zero, is encouraging both buyers and financiers of carbon credits to commit to purchasing CCP-labeled credits. And just one example here, the Norges Bank Investment Management, the NBIM, which manages Norway's 1.3 trillion euro government pension fund, has backed the CCPs in guidance to over 9,000 portfolio companies. So quite a lot of interest there. And we're now moving rapidly into a market formation phase at the Integrity Council, as Holly mentioned, one of the goals of the original task force. And governments that are setting up voluntary carbon markets are looking to the CCPs as an international standard. We were at the G20 meetings in Brazil, the ministerial meeting last month, and a great deal of interest in Latin America in setting up carbon offset and carbon crediting frameworks. The UK is going to endorse the CCPs as well, consider how to reflect them in policy, regulation, and guidance, Monetary Authority of Singapore, and so on. So with that as backdrop, let me turn to our excellent speakers to share their views on these topics. I'll start with Katie. Please go ahead.
Good afternoon. I'm Katie Thiel, Senior Sales Specialist of Environmental Markets at ICE Futures US. I'd like to thank the MRAC Subcommittee and Commissioner Johnson for allowing me the privilege to speak today on behalf of ICE as it relates to the evolving carbon credit market. ICE is proud of its energy and environmental markets that play a leading role in facilitating the pathway to net zero by providing price signals for energy, carbon, and environmental attributes. ICE is the largest environmental marketplace in the world. For the last 3 consecutive years, ICE has traded over $1 trillion in notional value across its environmental portfolio, including carbon allowances, carbon credits, and environmental attribute certificates. Environmental markets help internalize the cost and benefits associated with environmental externalities by incorporating them into economic decision-making. By creating financial incentives for conservation, pollution reduction, and sustainable resource management, these markets play a crucial role in promoting environmentally sustainable practices and achieving broader environmental goals. Like most markets, environmental markets allow for the efficient allocation of scarce resources through buyers and sellers voluntarily transacting with each other. Today, the only noteworthy liquid carbon markets have developed because governments have mandated entities to pay for their carbon emissions, which creates demand for carbon assets, including carbon allowances and carbon credits. Futures markets are transparent, regulated marketplaces that provide quality, high-integrity market infrastructure, providing both short-term and long-term price signals to allow for price risk management and facilitating the efficient allocation of capital. Quoted markets, like ICE's exchange-traded markets, democratize access to price, which levels the playing field of market participation and promotes the formation of liquid markets. Our clearinghouses mitigate counterparty credit risk through the central clearing, reducing systemic risk in the financial system. Clearinghouses manage margin requirements, enforce risk management standards, and ensure the efficient settlement of trades. Since most of our environmental products are physically delivered through registries, our intermediated delivery, that model protects the anonymity of the buyer and seller throughout the trade life cycle, while also improving the operational efficiency. ICE is always keen to participate in these discussions that support the growth of all environmental markets, including carbon credits. While futures markets do not directly assess the quality of the carbon credits, they can indirectly contribute to market efficiency and transparency, supporting the integrity of carbon credit transactions. The price signal of carbon credit derivatives conveys the view of market participants on, amongst other drivers, the quality and the integrity of the underlying carbon credits. ICE shares the CFTC's goals of advancing the discussion around sound and efficient exchange-traded carbon credit markets. We believe that our futures contracts are important economic tools, and regulated futures exchanges allow the market discovery process to evolve and operate at the highest levels of quality and integrity. I'd like to thank you for your time and consideration in being able to speak to the MRAC subcommittee today, and I hope these remarks from ICE are proven useful and supportive.
Thank you, Katie. Indeed, we hear this similar sentiments from exchanges all around the world, so thank you for setting that out about the important role of exchanges in these markets. Let me now turn to Christian Schneider from Nodal Exchange. Please, Christian, go ahead.
Thank you, Sonia. And also thank you, Commissioner Johnson, for inviting us today to speak on this very important topic. Nodal is a DCM focused on energy and environmental markets. And like our colleagues from Intercontinental Exchange, we list a wide range of environmental futures and options, both in the compliance and in the voluntary segment. So therefore, we very much welcome and applaud the effort of the Commission to address the current integrity issues in the market, because we explicitly support the cooperation between public and private stakeholders to develop voluntary carbon markets of the highest integrity and transparency. Now, the Commission issued this proposed guidance, which we very much welcomed as a step into the right direction. Nevertheless, let me comment on one aspect where we see it is problematic for the DCMs and subsequently make a suggestion as well. We believe that the proposed guidance goes beyond the existing regulatory framework, which already provides sufficient guidance and flexibility for the DCMs. Quality standards of listed contracts underlying commodities must comply with those established in the industry. And this is what we already consider when designing new contracts. With the proposed guidance, however, the Commission would effectively mandate DCMs to opine on all VCC crediting programs by asking the DCMs to consider, as part of their contract design research, whether certain standards applied by the crediting programs are sufficiently rigorous and reliable, sufficiently reasonable, sufficiently robust, conservative, effective, and so on. And we believe this goes beyond the current core principles of the regulation, which do not suggest that a DCM has to independently evaluate the sufficiency of underlying commodity contract standards. Instead of allowing entities which are most knowledgeable to determine and reach consensus on these standards. We think if adopted, this proposed guidance would propose significant new costs on DCMs, as we currently neither have the resources nor the expertise to assess applied quality standards of carbon crediting programs, which include very specific methodologies for worldwide carbon abatement projects. If adopted, we see markets rather moving further into the direction of opaque and unregulated OTC markets or foreign trading venues, which would not be subject to those standards. We believe that the carbon crediting programs and international standard-setting organizations are best placed to provide such guidance. DCMs are not required by regulation to possess the expertise necessary to opine on the sufficiency of quality standards in the underlying markets, and do not necessarily have the expertise in practice. However, market participants in voluntary carbon markets, they are much better placed as they have a lot of experience in addressing the quality standards, including concepts of additionality, transparency, permanence, and so on. Plus, there are already highly reputable international standard-setting organizations that are working on improving quality criteria in the voluntary carbon market as such. For example, Integrity Council for the Voluntary Carbon Markets or the VCMI initiative, looking at their core carbon principles that seem to significantly overlap with the VCC commodity characteristics of the proposed guidance, and methodologies have already been developed for each category of carbon credits, and assessments are currently underway involving multiple expert stakeholder groups in the market. So what we need is an independent standard-setting body with good governance and oversight, which employs market expertise to build consensus for creating transparent and robust methodologies, which then serve as a reference for DCMs when designing and listing new contracts. Once there is consensus on the quality criteria, I assure you every DCM has a natural interest to list contracts based on such framework, which ensures high quality voluntary carbon credits, and this is ultimately what the market participants want. We're happy to work with the standard setting bodies and with the Commission to improve market integrity and further develop the liquidity. Thank you.
Thank you for your remarks and for referencing the core carbon principles. We see this interest, again, around the world. Having heard these views from the exchanges, let's now bring in Mike Aquino online. He's Director of ESG at the International Dairy Foods Association. Mike, give us some buyer perspectives. Welcome.
Hi there. Thank you very much. Please thank you to the subcommittee for hosting virtually, because I was unable to be in DC today, so I appreciate that. So as was stated, I'm Mike Aquino. I represent the International Dairy Foods Association. And yeah, I'd like to offer a few comments from the perspective of the dairy manufacturing industry, but I do believe that my comments apply more generally to business communities operating along agricultural supply chains for various commodities. And so, as was mentioned, we're buyers. So the members of my trade association are potential buyers for carbon products, for carbon offset credits, for example. And I wanted to briefly touch on some of the supply and demand themes related to that. So currently, what we've observed is that corporate actors have some degree of uncertainty about how to utilize voluntary carbon markets. So many corporate actors have set ambitious climate mitigation commitments, as you know, but the existing accounting standards for accounting and reporting in the corporate space, especially if a corporation has set what is called a science-based target through an initiative like the Science-Based Targets Initiative or SBTI, there's uncertainty about whether we could purchase credits and apply them toward our decarbonization goals, help us draw down that carbon over time in this decarbonization journey, or if we would only be able to utilize offset credits, for instance, for the last bit of that journey when we're tackling what are called residual emissions. We do think that there are credible ways to integrate these market-based approaches, so the purchase of offset credits, for example, into corporate accounting and reporting. But I think in order to support that demand side dynamic of more demand for voluntary carbon markets, we need the standard setting bodies related to GHG accounting to acknowledge that there's a pathway that's acceptable for the integration of those market-based solutions. In order to get there, then we go over to the supply side, and all of the quality issues that were mentioned already, especially in the previous panel, come into mind. So my industry was quite happy that CFTC guidance was put out there, because we think that more guidance on these underlying assets of carbon derivative products will bring some important structure and guardrails and standardization to the credit generating process. And then that should increase the quality of the offset supply. And with more quality and trust in that offset supply, we think that it supports the case that market-based interventions are indeed acceptable to utilize in that corporate decarbonization journey. So that was a little on what we're seeing from the supply and demand side. I will say U.S. agriculture generally sees voluntary carbon markets, if they are trustworthy and have a reputation of not leading to greenwashing outcomes, for example, we see lots of opportunity for U.S. agricultural producers to continue in many of the climate smart activities that they know how to do, and expand those activities to because of the new revenue streams. So it's welcome. We just need this all to come together as far as the standards and the quality issues. And then, since the topic of this panel is somewhat market intermediation, I just wanted to quickly note that our industry feels the figuring out of the cross-registry monitoring will be key, especially knowing that some jurisdictions may have regulatory or compliance marketplaces. And we want to make sure that credits are not included in multiple registries. And so that's something we're watching, especially because in some cases, at least in US dairy, we are already interacting with some existing compliance marketplaces. So for example, the low carbon fuel standard marketplace in the Western US states We would love to engage on this topic more with CFTC experts and USDA, but we see some scenarios, for example, in the future where producers may not have that opportunity anymore to sell into low carbon fuel standard marketplaces. They may want to use that same carbon intervention and sell into the voluntary carbon market space. And we're concerned that, one, we need to, again, look at the cross-registry monitoring piece so that there's no double counting, if you will. We want to avoid that, but we also want to make sure that methodologies are consistent. So what works for an accounting methodology to quantify the size of the carbon reduction, for example, the carbon benefit in a certain compliance marketplace, might not be the same methodology that would be accepted by the voluntary carbon market community. So these are just one example of some of the scenarios we'd like to explore further. And generally that gets back to, if we're not monitoring across those registries, we think the demand will not develop as we hope it does for voluntary carbon markets, because there's an uncertainty there of, if we buy them, will we be accused of greenwashing, say, the corporate brand owners, and when we have to report our carbon emissions. So those were my opening remarks, and then I'm happy to discuss. Thank you.
Thank you so much, Mike. Fascinating points, including on the need for interoperability in standards. I know we're short on time, so Peter, I'm going to hand back over to you. Great discussion.
Thank you very much, Sonia, and thank you, Christian, Katie, and Mike. I want to turn to our third and final panel, which is on product design and reliability. For that, our panel members are Marianne Griffin, Compliance Director of Low Carbon Solutions at BP Products North America, and Angela Davis, who is at Citigroup Energy and ICG Legal Markets and Security Services as Senior Counsel. Our panel is moderated by Peter Malashev, Adjunct Professor, George Washington University Law School. And Peter, I'll turn it over to you.
Thank you, Peter. Thank you, Commissioner Johnson. Your thought leadership is very much appreciated. These are extremely important markets, because if we all turn into an uninhabitable desert, nothing else would really matter. We're all doing our part. Tamika and Peter, thank you for making this happen, this great panel. So to set the stage, there have been remarkably insightful comments made, and we're all coalescing, I think, along the same topic. What can we do? What part can we play? But as lawyers, we also have to set the stage. What are really we're talking about here? So first off, what is a carbon credit? What type of thing is it? There are really three possibilities. First, it could be a commodity. Secondly, it could be a security. And third, it could be something else, some sort of property right or intangible. Looking from, and the way we come out of this debate has very significant legal implications as to how we proceed with either regulation or some sort of set of standards. So as far as commodities have been listed in the Commodity Exchange Act since really 1921, but there is no test to identify what is and what is not a commodity. There have been several court cases and CFTC guidance, and generally something that is fungible, that is standardized, that is traded in interstate commerce, that could be a store of value, serves economic purpose, and is, with respect to physical commodities, is deliverable, would generally be considered a commodity. Again, there is no specific test to determine that something is or is not a commodity. CFTC's and SEC's 2012 product definitions discuss environmental commodities, and they have been identified as such, as commodities. So we generally would assume and could assume that products that are carbon credits that traded interstate commerce would be considered to be commodities. So secondly, they could also, the environmental products, so could also qualify as securities. There is a somewhat convenient Howey test. It's been applied in numerous times, particularly more recently in the crypto and fintech area. And some of the projects that we see on our desk as lawyers may actually qualify as securities. So we do need to conduct that analysis. As was mentioned, the SEC has just finalized their disclosures rule relating to environmental commodities and climate change. So they're clearly looking into this asset class as well. And thirdly, these types of instruments or products can qualify as property rights, some sort of legal right, a legal property right or intangible property. Compliance markets, through their state regulators, have made those pronouncements with respect to the compliance markets in carbon, for example, California. So all of these concepts are very important to identifying what the projects are, because if something is a commodity, CFTC immediately has enforcement jurisdiction to prosecute for fraud and manipulation, but the CFTC would lack regulatory jurisdiction with respect to these products. And likewise with securities, if something is a security, as remember, agricultural commodity orange groves, then the SEC would have jurisdictional reach. Secondly, we do need to also touch on what type of contract this is. And this has already been identified in the first and the second panel as to how these products trade. The first broad category would be spot, forward, or some other form of commercial contract. So these, again, these are only give rise to CFTC's enforcement jurisdiction, not the regulatory. But the second group of contracts, such as swaps, options on futures, would certainly give the CFTC exclusive jurisdiction. And this is what the guidance that came out in December focused on, that was discussed, that the CFTC put the focus on the DCMs, and the DCMs were further on encouraged, or I don't know what the right verb would be here, guided, to look into the underlying projects that would be in the spot and forward and commercial world that the CFTC otherwise would not have the reach to. So obviously there are numerous issues that we need to look into as we go forward. There are lots of issues coming up also in the context of tokenization, because a lot of these products may also qualify as digital assets. There's a lot of work going on along those lines. So this is obviously something for future discussion, that we're just in the beginning of this process. So let's jump into to the discussion. Mary Ann, BP obviously doesn't need introduction. It's one of the largest commodity traders and also financial traders. So what are your thoughts?
Thank you, Peter. First, I just wanted to thank you, Commissioner Johnson, for inviting us here and giving us the opportunity to participate in today's meeting. My name is Mary Ann Griffin. I am the Compliance Director for our Low Carbon Solutions business in BP's Trading and Shipping Group. And I'm based in our Chicago office. We appreciate the opportunity to participate in the CFTC's MRAC roundtable today, and we also appreciate the CFTC's attention to the voluntary carbon markets. BP has actively participated in both the voluntary and compliance carbon markets since 2001. Within BP's trading and shipping business, we have a global low-carbon trading business that plays a vital role in connecting BP and our customers to carbon pricing through our activity in the world's compliance and voluntary carbon markets. BP sources verified carbon credits issued by internationally recognized carbon credit organizations, which provide independent verification of the environmental integrity and transparency of carbon credits that we supply. As part of BP's participation in these markets, we continue to support integrity, transparency, and initiatives in trade associations is intended to help. As part of BP's participation in these markets, we continue to support integrity, transparency, and effective market design of the voluntary carbon market. BP's participation in the following initiatives and trade associations is intended to help support the development and strengthening of compliance and voluntary offset markets. ICVCM, Integrity Council for Voluntary Carbon Markets. Also, the UK Voluntary Carbon Markets Forum convened by the City of London Corporation. The International Carbon Reduction and Offset Alliance. Natural Climate Solutions Alliance, convened by the World Economic Forum and World Business Council for Sustainable Development, and the Oil and Gas Climate Initiative. BP looks forward to future opportunities to collaborate on voluntary carbon market design. We support the use of carbon credits for the reduction, removal, and avoidance of carbon emissions by companies, countries, and society. They play an important role in enabling the world to meet the Paris goals. We thus support well-designed policies that promote the regulation, incentivization, and accelerated deployment of carbon emission reductions and removals. And we commend the CFTC's recent efforts to promote transparency as well as fair and orderly trading in the voluntary carbon market. BP appreciates the work the regulated exchanges have done to develop innovative financial market products that enable market participants to manage their risks in the voluntary carbon market. We believe that the credibility of the regulated exchanges and the VCM registries such as VERA and ACR has a direct effect on the credibility of the voluntary carbon market. We support efforts by the CFTC to proactively drive the market toward higher quality by ensuring its regulated exchanges are held accountable and are the gatekeeper for the viability of the products they list. Furthermore, we support the role of the CFTC to facilitate reforms that protect all participants, including voluntary carbon unit end users, market participants, regulated exchanges, VCU registries, project developers, and project verifiers. We believe the CFTC has an important role to play in encouraging increased transparency and integrity in carbon markets, thereby increasing market participation and ensuring that this market is effective at meeting the goals of the Paris Agreement. In conclusion, as MRAC plans to work on climate-related market risk, including by launching a subcommittee, we hope to be able to contribute to this work. BP participated in an earlier iteration of the Climate-Related Market Risk Subcommittee, which published the 2020 report entitled Managing Climate Risk in the U.S. Financial System. Thank you for allowing BP this opportunity to describe its business and interest in voluntary carbon markets. Thank you.
Thank you, Mary. Thank you, Mary Ann. Let's turn on to Angela Davis. Angela, please.
Hi, I'm Angela Davis. I am a lawyer with Citigroup Energy Commodities located in Houston, and have been asked to describe what I'm seeing in the market with respect to this product, which is really to say not much. We are very active in the renewable energy credit market. We're very active with compliance products, California carbon offset allowances, Washington carbon allowances, as long as that market lasts. We see requests from clients for reggies. We see EUAs, but we really are not seeing much in the way of interest here in the US for voluntary carbon allowances. I will say, though, we have looked at more on a mundane note, issues of contracting to purchase and sell these products in the over-the-counter market. And I think there's maybe a little culture shock ahead for US counterparties with respect to documentation. If you look at in Europe and some in the US, if you look at the AIDA form, or if you look at the most recently published ISDA VCC Annex, you will note, if you read carefully, that basically all you're being told if you're a buyer is we give you what we have. Not exactly what we have, but we will give you everything we have, which is, I think, for many counterparties, not really what they think they're getting. So I would foresee as these markets become more active, particularly the over-the-counter market, there's going to be a few surprises for parties when they actually try to contract for these purchases. And that's all I have.
Thank you, Angela. We're running short on time, so let's do a quick roundup with a few questions to finalize. Peter?
Yeah, actually, unfortunately, I think we're over time at this point. So
That's complete. Okay.
Yeah, so we thank everyone for their participation today. Marianne, Peter, and Angela, thank you very much for your comments, and to all the other panel members here today. Look forward to future work with the subcommittee, and just want to turn to Commissioner Johnson for any closing remarks.
Yeah, thanks so much, Peter. Peter J. and Peter M. Our office is affectionately now referring to each of them as, because of how closely and intimately we've been working to really begin to, I loved Mary Ann's point, continue a conversation that began several years ago here at the CFTC. I had mentioned to Sonia just ahead of the start of the panel that we are grateful for all of the voices that have come together around the table today, but we are really hopeful to begin to outline a set of action items that we can use as a point of departure for helping the Commission to shape its regulatory framework going forward. So this is, as we note from the last panel, far too short of a moment in time for us to cover all of the things that you all have raised, but I'm hopeful that this is an agenda-setting meeting. And following up on this meeting, we will have marching orders for what I would like to host a series of conversations, much longer than time we allocated for today's conversation, that really delves deeply into some of these issues. We chose very explicitly today to have a public meeting, and part of the motivation for that was to invite stakeholders who are perhaps represented by viewpoints as part of the subcommittee, but not present here today. And one thought is that upon hearing all of the conversation and discussions that we've had, that they would also sort of contribute to organizing this regulatory framework that the CFTC would ultimately adopt. So I want to pause here because we are over time. I want to be exceptionally sensitive to the other commitments you might have today, and for several who have traveled to be here, I can only say I'm tremendously grateful that MRAC and the subcommittee are tremendously grateful, and that today is the beginning of many conversations. And so we're really hopeful that more than sort of saying goodbye for today, we're saying we'll see you later. And as was mentioned at the close of the previous panel, the see you later might be see you quite soon. So looking forward to seeing all of you or working with many of you on the subcommittee as we move forward. Thanks, Peter.
Thank you, Commissioner. I want to thank everyone for attending today, and the meeting of the MRAC Climate-Related Market Risk Subcommittee is adjourned.
Thank you.